Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's being shared. If you want to follow me, it's at Finance Score Finance. And if you want to join our community, finding-value.com. We've got a question and answer session today, Sunday, which is at 5 p.m. Mountain Time, and we're going to go over what drives stocks up and down, and what drives the stock prices. So we have a special going on. Special is the coupon code if you'd like to join and see that. So we've got Andy Moss here. Good morning. Welcome to the weekly chart thread. I was just looking at this chart. I look at a lot of different charts. This one here is the S&P 500 index. There's something that I can gather here quite readily here. Whenever you come off bottoms, you generally have stronger impulse moves up. And the bottom is way behind this one. But you can see the upward impulse moves are getting less strong. They're not as long. And it's consolidating into a top here. So think of that as like a rising wedge. And I generally see this type of movement at bottoms, except it's in a falling wedge, or tops, which is a rising wedge. And it doesn't have to create a perfectly good looking wedge either. It can just be roughly speaking. But what I do see is I do see the momentum slowing, and we very well could head a little bit lower here with that bearish engulfing that we just received here. Now, again, will it just be a retest back to this level similar to 2024 July, August timeframe? It very well could be. We'll have to see what the follow through looks like. But I do see that contraction in size as we're going up, and we're definitely contracting in the forcefulness of those impulse moves higher. Another shift worth considering, still early, but when this relationship reverses, it can persist for years at a time. And what he's looking at, this is the sector makeup of global ex-US equities helps, and valuations are also supportive. So this is MSCI All World excluding US versus equal weighted SPX. So it's VEU RSP. So I went over here, did VEU divided by RSP. And this is what it looks like that he's charting here, and we potentially could have like a double bottom going on that he sees, and that very well could be the case when we look at these things. What I did is I put another one. I did EWZ divided by RSP, and you can see a little bit more, coming back the outperformance of EWZ versus the equal weighted S&P 500. We peaked, and then we headed lower, and this is the cycle. This is the exact cycle that I always talk about, and that I am teaching on the website and whatnot. And then we can see we went all the way down, and we've consolidated sideways here for a while. What's going to cause this movement for this to go up? Well, check this out. The Brazilian real versus the dollar. Now, let me put this one below here. So you can see the Brazilian real coming on up with EWZ outperforming the S&P 500. Double top, and then we've come all the way back down and are trying to, I think, put in a bottom at some point. What's the driver here? Well, in my opinion, it has less to do with what people think is driving it and more to do with currency exchange rates. As I dig deeper and deeper into all of these things, what really comes down to is the exchange rate. And some of these companies, they borrow in dollars and earn in different currencies. So when someone says, well, that's not that big of a deal, hold on a second. So this is the Brazilian real. divided by the United States dollar. When we look at the outperformance of just the currencies stacking up here, so if we take this isn't the absolute bottom, this is '03, but this was a currency appreciation against the United States dollar during that time frame of 122%. So a lot of this juice was squeezed through the currency. And then if you're in a commodities bull market along with this, which I think is one of the drivers for the currency being so strong, we could see a big outperformance in some of the emerging markets based off currency exchange rates. Here's your 1, 2, 3 hump consolidation. Generally, you get a 3 hump consolidation lower and a falling wedge. Check, check, and check. Then you get a double bottom. That double bottom that he was referring to in here is also aligning with these currencies putting in a potential double bottom. And this would be the bottom of the double bottom, potentially, if we do work our way on up. Some of the companies, when I go and I do research and I look at where they're at today, I think the potential of some of them could easily be between 20 and 100x because of the currency exchange sitting that you're looking at right here and the potential move that we could get working our way on up. The value there and how little we pay for the companies is very undervalued. And it's not just the Brazilian real. You can look at other currency exchange rates where they're exactly the same as last time, where I think we could get a move higher. Now, we haven't broken out yet. A lot of people say, well, it's too dangerous. No, you can bottom pick a whole bunch of different companies and get incredible entry points. Now, some people say, we need to wait for a breakout. It's like, guys, we've got confluence all over the place here. We've got the GBP breaking out. It's sitting on top. It's already broken out. It's ready to run. It did that last bull market. We've got the DXY, which is another indicator. Last bull market, bull market, bull market, and we'll probably get a bull market there as the dollar starts to turn over. Trump even talks about the potential weakening of the dollar and the weakening of interest rates, which are interconnected. So he's coming out and telling you what they're going to do. So I think this is going to weigh very heavily on the S&P 500 as that dollar drops. So I think that we are going to, here's your rising wedges all the way up into this corner, the breakout of the rising wedge, potential double top of some sort, and then the move lower. And that coincides with a weaker dollar. It coincides with stronger commodity currencies. It coincides with the ratio bottoming here, just like he's got it. They're all interconnected. Everything that I'm teaching or showing you or telling you or whatever you want to call it is interconnected. The real key to making money in stocks is to not get scared out of them. So when we're getting at these bottoms here, the whole key here is to get in early, to be patient, and then wait for these things to just rip. The valuation is what's protecting us. The asymmetry, the risk reward, all of it combined. And then you've got all that confluence in the charts between currency exchange rates, the bottoming patterns of the equities themselves, the low and turning ratios of all these different asset versus asset ratios that we look at. They're all interconnected. It says, maybe my coolest chart lately, I just designed it and hope you enjoy it. The stock market's high enterprise value to EBITDA ratio minus its low dividend yield equals 13.8. That is higher than all of these bull market peak dates. So what this means is that money is piled into these financial stock market assets. And right now, the valuation is greater than basically any time in history. That ratio bottomed in 1981-82. That was the time of everyone's life to buy financial assets like the NASDAQ, the stock market, the S&P 500 stock market is what I mean by that, Dow Jones Industrial Average. And then when interest rates were lowered, it forced people out of the bond market. So when interest rates are really high, money gets sucked into the bond market because you can get a quote risk-free return from 10-year yields and 30-year or 10-year bonds and 30-year bonds. When interest rates get lowered over time, money migrates out of the bond market into the stock market. And with interest rates bottoming in 2020, 2021, it pushed all of these assets over into financial assets. The problem is we had a 40-year decline in interest rates. And that is what everyone in the stock market knows. And they say, oh, well, stocks are good. They've done well for the past 40 years. They don't know why they've done well. They've done well because of the interest rates declining and money flooding into the stock market because it couldn't get a return in the bond market with low interest rates. So this is a resultant of interest rates going down for 40 years. And this is what it looks like on the chart of the bond market declining during that time frame. So here's the interest rates. So the stock market does well, generally speaking, if you've got a stable environment and interest rates are low, because it forces money out of the bond market into stocks. And that's this entire trend there. It does cycle. You're going to cycle up and down as you go, the stock market, along with interest rates. It's not going to be one straight shot. But for the most part, the tailwinds are behind it. What we've got now is the tailwinds have shifted. Now we've got headwinds as interest rates move on up. Now, could there be the last peak and then we move lower here in rates and then come back like that? That is a very big possibility. And the reason we would do this is because the stock market starts to crash and they'll try to save it through interest rates. The problem is when interest rates come back down, it's going to blow up a housing market boom. Housing market boom is very inflationary on top of the fiscal spending that we've got in the markets. So I think it will turn and work its way back on up if this is the path that it does take. So that is a possibility. I'm not saying that is 100% outcome. But we've changed from tailwinds to headwinds. And when interest rates go up, money will migrate out of bonds and out of stocks into non-financial assets, which is a hard asset regime like we did here. This was a hard asset regime where all of hard assets did incredibly well during this period where they cycled on and off in an upward trend with the tailwinds behind it. I think that's what's coming because of interest rates. And these valuations are a function of those interest rates. Jamie Dimon selling JP Morgan, Warren Buffett selling BAC, COF. That's the BAC is the what is that? Bank of whatever. This is Citigroup, Bank of America, I think. COF is the Capital One Financial, and I don't know what new is. Must be another bank. So they are selling all of the banking stuff down here. Citigroup, Capital One Financial, Bank of America. And he's adding to Domino's Pizza, Pool, Sirius Holdings, VeriSign, Occidental Petroleum, and Constellation Brands. Get your Modelo beer there and Corona. Doge has to be accountable or has to be held accountable. It is completely impossible for Doge to save $2 trillion, Jessica Radell, an economist and senior fellow at the Manhattan Institute, a conservative-leaning think tank, recently told CBS. 2/3 of the $7 trillion federal budget goes to Social Security, Medicare, defense, veterans, and interest on the debt, all of which have been taken off the table by President Trump. Saving $2 trillion will require eliminating nearly every remaining federal program. Unfortunately, Radel continued, Doge has no legal or constitutional authority to cut this spending. Congress must pass a law. That's what's going on there. Looks pretty dire for for fiscal spending. I think we're going to spend more than what we bring in revenue wise, no matter what. Here's Jamie Dimon selling a whole bunch of shares of JP Morgan stock worth nearly 250 million. These guys know what's up. They're getting out of the bank stocks, all of them. Maybe there's going to be a banking crisis or something. I don't know. The biggest spike in uncertainty since the global pandemic and 9/11, the wall of worry, or is this time different? So this is US Economic Policy Uncertainty Index. Huge move up in the global pandemic. We had another big move in the global financial crisis, another one for 9/11. We had an EU currency crisis, which didn't transpire into much, but we've got this spike here in US Economic Policy Uncertainty Index, which coincides with a lot of other crises in history. So, is something going on here? I'm not sure, but there's a spike there. Usually the news comes out later. Rick Staton says, most of us are happy to hold intangible assets. I call this the intangible bubble, and one day people will want to see actual value. I completely agree with that. This is tangible versus intangible assets. Intangible assets currently account for 90% of the S&P 500's total assets. And there it is. And we're going to see a shift with that interest rate going up, I think, from financial assets to hard assets. And financial assets, I'm talking about intangible assets. And right now, that's where all the money has piled into. Um, Hard assets were a huge driver in 1975, and you can see in 1982 it bottomed, and then we started the intangible asset outperformance. I do think that's going to reverse out in the future. If you're a gold stacker and value thing in terms of real money, UK house prices have been in a bear market since 2004. I think the real estate market, we're going to go through a real estate boom, but gold will outperform it. Gold's going to outperform the real estate index. Even though we're going to go through a real estate boom and house prices will go up, the market conditions will favor gold, silver, and platinum to outperform based off their valuation metrics and what they do under these market conditions. So that's what we see. We saw the bottom was in 1982, and that's where we had a large outperformance of gold and silver. We have the same scenario that started in 2004 peak, and we've rolled on over, and I think we're going to go really low here. Captain Forsyth says DISTI, which is basically diesel, distillate stocks, inventory falls below the 5-year cloud. Look at that. We're coming out the cloud here. Very low inventories given where we're at seasonality-wise. Usually we get spikes upward. We didn't get a big spike here. How many people have over 10% of their portfolio assets in cash, gold, or just cash alone? I bet it's under 1%. The next bear market is going to crush a lot of people whenever it comes, and it will come. I think the bear market won't be in, gold. He's got cash and gold there, but it's going to be in the S&P 500 and dollar-denominated assets. In the stock market, intangible assets is what you could say. I think that's where it's going to get hit. If you're in the undervalued assets, it's possible, like commodities and precious metals, mining companies and stuff like that, they could get hit in the short term, margin calls. It all depends on how fast it goes down. And that is the big unknown. The stock market is a device for transferring money from the impatient to the patient. I'm going to continue to keep using this quote and saying it over and over. This is where I think a lot of people are the weakest here. I know that sometimes I get a little bit impatient when I was a newer investor, and now I just force it. I just sit there and do nothing. And I try to find the value discrepancy out in the market between the price and the value of the underlying security, buy it and just sit in it and wait for that market condition to change into favorability. If we've got a falling wedge, much like a lot of these currencies do and stuff like that, and a lot of the charts, ratios, a falling wedge indicates that we're about to turn, and we're basically at the tip of the falling wedge, or we're doing a bottoming pattern after it, which is where we're at. So now it's just a matter of time. Because remember from last year, is it starting to make sense yet? So this is the US 10-year yield minus the 2-year yield. It's the yield curve, so the yield curve inversion chart, and it's coming back on up. And here we had this was a real estate market bust. This one here was the dot-com bubble bust. This is another real estate market bust. This was a shutdown, so I don't know how legit that is, but here we could have another problem, right? So one of the things that I look at, and if I were to go and scroll down into some information that helps with looking at this, one of them is construction unemployment. That's one of the metrics I look at. So we can look at a couple different metrics. This one is all employees construction. And during these bust phases, we had 1990, which was a bust phase. That's this phase right there in the turnover. This was a leading indicator for that recession. Here's the dot-com bubble. We had another rollover in U.S. All employees construction. This was the big bust here. This is a deleveraging event, and that you could see the unemployment that hit construction. Here was the other one here, but this is more of a shutdown, so it's kind of I don't know. It's like they purposely stopped that one. And right now we haven't rolled over and we're not really going sideways yet. I'm not saying it can't. It just hasn't happened yet. So it makes me think that we don't have a potential recession yet because it hasn't rolled over, but it very well could. This is one of the things that I look at. Here's these other recessions here. Almost always it hits these. This was 1974, 1980. We can even throw a gold chart on here. And gold does real well when this rolls over and then comes back. So, yeah, it's hard to see on that. But there's the rollovers there for construction employment, which is, I would consider to be a leading indicator. Another thing that I thought was real interesting is your M2 money supply divided by gross domestic product. It seemed pretty well managed throughout time here. We had a nice big, I'll say, disinflationary period from 1987 all the way to mid 90s. We bottomed in that, and then 98, 99, we had the money printer ripping. And the money printer, M2 money supply, was growing faster than GDP during that time frame. Look what we have here. We have another similar, we had a big pullback there. This pullback started in June 2020. The money worked its way through the system about 18 months to 24 months delayed. And then we rolled over in 21, 22, came all the way back here where it looks like it's bottoming and starting to turn higher, where M2 money supply is starting to outperform GDP, which means inflation. Could be very inflationary. Another one that I want to talk about is PPI to CPI ratio. This is your producer price index divided by your consumer price index. Your big disinflationary period is this entire downward move all the way to 2002. Your inflationary boom phase was this one. It went up where the PPI ratio outperformed the consumer price index. What that means is that the producer prices were going up faster than consumer prices, which is inflationary. It bottomed in 71 and came all the way up, and then the pressure stayed on all the way from 74 to 1981. That's your inflationary period. So your PPI was flowing through into CPI at a steady pace or steady state here. So it led first, as inflation comes through the system, it comes through commodities through the producer price index, which then feeds through into the consumer price index, and it fed all the way through to the end. Now, if we look at what's happening, we've got a gigantic double bottom. Bottom one was 2002 and bottom two was 2020. We hit our head on resistance here, and then we pulled on back. And if we look recently, if I were to kind of zoom in on this right-hand side here, we are starting to fall in a falling wedge and break out of it. You can see that it's starting to turn higher again, where the PPI is starting to outperform the CPI. So that's your breakout, where we're going to come into another inflationary period, perhaps. And then what can be crazy here is if we do a projected move, which is the size of this guy here, and projected it upward, roughly speaking, uh, that's probably where we could end up. If we end up anywhere near this, what that means from this level here is that we enter a gigantic inflationary period, which will dwarf the 1970s. It will dwarf it because we're coming from such a low level, and the PPI to CPI ratio is going to massively outperform and drive the consumer price index way up to potentially that level up there, which is going to be very inflationary. And that also matches all of the other charts, the intangible versus hard assets, the bottoming patterns. It's all interconnected. And even this, it's interconnected. Now, I don't know if we get a recession first. Tough to say. I don't know. Investment wisdom, we don't buy and sell stocks based upon what other people think the stock market is going to do. I never have an opinion, but rather upon what we think the company is going to do. So it's all company focused that Warren Buffett does. Here's another one. It says markets are showing clear signs of stagflation emerging in the economy. Real yields have been declining, but the key development is the divergence between inflation expectations and falling nominal yields shown in the chart below. Other indicators point in the same direction. Notably, retail sales are now contracting at an annualized rate of over 10%, and that's in nominal terms. In real terms, the decline is even more severe. At the same time, the Fed's preferred supercore inflation index is rising at an annualized 9.5%. This is a textbook stagflationary environment, unfolding as fiscal spending slows and global central bank assets continue to decline from their peaks. So here's the 10-year yield coming back down there. And this is the US 10-year break-even rate moving higher. So we've got inflation and growth separating, which is stagflation. The environment that stagflation does real well, what assets do very well? Gold, silver, platinum did well, oil does well too. So commodities do very well in stagflationary periods, and I think that's what we're entering. That's also what this is suggesting. It's suggesting a very stagflationary environment. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We've got special coupon code. We've got a Q&A session coming up later today, 5 p.m. Mountain Time. And I'll see everyone there. So catch you later. See ya.